Alright, continuing with the Chapter 11 presentation, we're on slide 38 now of the package on accounting for treasury stock. And note on this slide that treasury stock is a contra stockholders' equity account that is debited when stock is reacquired by the company with the accompanying credit to cash. Therefore, treasury stock reduces stockholders' equity overall. So these are important points for you to remember. On slide 39, here's an example of a treasury stock acquisition by the company with a debit to treasury stock and a credit to cash for the amount of the repurchase, which in this case is $32,000, 4,000 shares at $8 each. On slide 40, note the placement of the treasury stock on the partial balance sheet shown on this slide. It is subtracted from the total paid-in capital and retained earnings to get the total stockholders' equity amount. Going to slide 41, a review question, and the answer is D, which actually it could be any of the answers A through C as previously discussed. On slide 42, now we shift to a preferred stock, which, as its name implies, gives the holders some preferential treatments over common stockholders, as noted on this slide. That is, preferences as to dividends, to assets in liquidation, although preferred shares are non-voting. Each paid-in capital account should identify the source stock to which it relates, either common or preferred. On slide 43, the entry for an issue of preferred stock in excess of par is the same as it is for common stock, except that the preferred stock account is credited and paid-in capital in excess of par preferred stock is credited. As noted on the slide, preferred stock may also have a par value or not. On slide 44, this slide discusses the dividend preferences of preferred shareholders. That includes the cumulative dividend privilege. So when you see cumulative identified with preferred stock on the balance sheet, this is what it means, is that holders of preferred stock must be paid their annual dividend plus any dividends in arrears before the common stockholders receive dividends. So they are the first in line as far as that's concerned. On slide 45, preferred shareholders also have a preference on corporate assets if the corporation fails. This preference may also take precedence over creditors, although in most cases it does not. Creditors come first, then preferred shareholders, and then common shareholders. Excuse me. Okay, another review question, and on this one the answer is D, 135,000, as a result of the following calculations, which you'll see here in the scripted presentation. I'll just kind of read it off. The annual preferred dividend is 8% of the $100 par value, or $8 per share. So that's the first thing we need to look at. So that's the annual preferred dividend, $8 per share. 10,000 shares times $8 per share equals $80,000 of preferred dividends per year. And you multiply that by 3 years, 2008, 9, and 10, and that gives us 240,000. And therefore, the amount available for common shareholders is 135,000. That is 375,000 total that they want to pay in dividends, minus the 240,000 that needs to be set aside for the preferred shareholders. On slide 47, a dividend may be in cash, shares of stock, property, or even scrip, or a promissory note. Dividends are expressed as a percentage of par or stated value, normally with preferred stock, or as a dollar amount per share, normally with common stock. On slide 48, a corporation must have retained earnings available to pay dividends in cash. There must also be adequate cash on hand and a declaration of dividend payments must be approved by the board of directors. On slide 49, there are 3 critical dates regarding dividends as shown on this slide. The declaration date is when the board authorizes payment of the dividends for shareholders of record as of a certain date. Only shareholders who own shares on the record date can be paid dividends. This date provides a definite yardstick to measure the amount of dividends to be paid, and also provides a bit of wiggle room for investors to jump on the bandwagon or off between the declaration date and record date. The payment date, of course, is when the actual dividend payments are made. On slide 50, note that the accounting entries that correspond to the key 3 dates. Excuse me. The authorization by the board is an economic event that must be recognized via an accounting entry. It matters not who the owners of record are on the record date. The fact is that the amount of dividends has already been determined at 50 cents a share on the 100,000 shares outstanding. That is why no accounting entry is involved at the record date. Note the use of the cash dividends account to differentiate from dividends paid in other ways, that is by stock, etc. Note also the payment date entry, which debits dividends payable and credits cash. And on slide 51, another review question. And as shown on the previous slide, the 2 dates where entries are required are the declaration date and the payment date. On slide 52, stock dividends are dividend payments made in shares of stock. The impact is a decrease in retained earnings and associated increase in paid-in capital, as illustrated on the slide. On slide 53, stock dividends can be a good move for the corporation for the reasons stated on this slide. It's a way of satisfying the shareholders without a cash payout. On slide 54, stock dividends change the composition, not the amount of total stockholders' equity. They do increase the number of shares outstanding. So this too is important stuff for you to remember. And on slide 55, we have an example of a stock dividend being declared of 10% on its $10 par common stock, where 50,000 shares were outstanding. The market price, however, was $15 per share. So, excuse me, in determining the amount of the stock dividend, we need to look at 2 things. What is 10% of the current shares that are outstanding? So we're talking about 10% of 50,000 or 5,000 shares that are going to be involved in this stock dividend, and they're going to be issued at the current market price of $15 per share. So we go down below and see the impact on the balance sheet before the stock dividend and after the stock dividend. We need to recognize why the amount of the stock dividend is 75,000, and that is the 5,000 shares of the stock dividend times the $15 per share market price. And then note also the transfer of the stockholders' equity from the retained earnings to paid-in capital as a result of the $75,000 stock dividend in the before and after. I'm moving to slide 56. The stock split is a totally different transaction from the stock dividend. When stock is split, normally 2 for 1, this reduces the market value and increases the shares outstanding. Excuse me. There's no entry recorded for the stock split, but it obviously has an impact on the shareholders and the market for the stock. And on slide 57, note that the overall value of stockholders' equity does not change, just the number of outstanding shares after the stock split. And going to slide 58, This chart shows that the stock dividend has more impact on the balance sheet, although not on the overall stockholders' equity balance, than the stock split, and only decreases the par value per share, as well as increasing the number of outstanding shares. So that little chart there showing the impact on paid-in capital, retained earnings, and so forth of a stock dividend and stock split is important for you to remember for potential quiz and exam purposes. Excuse me. And on slide 59, another review question here. Which of these statements about stock dividends is true? Well, as stated before, a stock dividend has no overall effect on total stockholders' equity. It simply redistributes the existing stockholders' equity by decreasing retained earnings and increasing paid-in capital. So it's simply shifting between those two main areas of the stockholders' equity. On slide 60, this slide is partially a review of what we've discussed about retained earnings in prior chapters, that is the first two bullets, and partially new material, the last two. Retained earnings is part of stockholders' claim on total assets of the corporation. That is why it is a part of the total stockholders' equity on the balance sheet. Retained earnings has a normal credit balance, so if it had a debit balance, this would be identified as a deficit instead of a surplus as a normal credit balance would indicate. On slide 61, note in the above example how the accumulated deficit in the retained earnings account and the treasury stock are both subtractions from stockholders' equity. At that point, we'll wrap up this part of the presentation and finish it off